Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
The recent price action in AZI Internet Technology, NASDAQ ticker AAZI, has been nothing short of explosive. I mean, we are talking about a stock that was frankly fighting for its life, trading below $1. And then bam! In mid-December, it jumps nearly 40% in pre-market, follows up with massive volume, and holds on to over 20% in sustained intraday gains.
Right.
And this whole violent move is really the culmination of two critical, almost simultaneous events. First, the 1-for-50 reverse stock split that went into effect on December 12th. And then, just 4 days later, this announcement of a huge $980 million non-binding MOU.
Memorandum of Understanding, yeah.
Exactly. So the central question for us is this. Does this sudden, intense re-rating reflect a necessary and, legitimate corporate action designed for survival and future expansion? Or is it just the predictable output of some very sophisticated financial engineering? I'm going to argue that management's moves were necessary, aggressive steps to secure NASDAQ compliance and show a real plan for growth.
And I'm going to come at this from a very different angle. You've laid out the facts perfectly, but I believe the movement itself is the product here. I'm going to contend that this volatility is purely mechanical, a consequence of management creating and then ruthlessly exploiting microfloat dynamics. This surge is, in my view, entirely divorced from the deeply perilous fundamentals of the business. This isn't a rescue story, it's a story of exploitation.
I understand the cynicism, but my position really begins with corporate necessity. I mean, we have to remember where AZI stood in late 2025. They were facing an existential crisis. They had deficiency notices from NASDAQ, a delisting threat, because they were failing two key metrics, the $1 minimum bid price and the $15 million market value of publicly held shares. When your stock is down 97% from its IPO price, you are functionally out of options. So the 1-for-50 reverse split, that wasn't optional. It was a non-negotiable compliance measure effective December 12th, just to stay listed.
Sure, to stay listed, okay.
And furthermore, given their extreme financial fragility, the company had just under $2 million cash on hand and was running chronic net losses of almost $11 million, that $980 million MOU, even if it's non-binding, was a crucial strategic signal. Management needed to establish external confidence, a credible future revenue pipeline. This MOU is a necessary step to fund the expansion plans needed just to keep the lights on and justify their listing. It shows they're fighting, addressing the fundamental threat that caused the crisis in the first place.
That's a compelling argument on the compliance front, but I think it dangerously conflates the necessity of the split with the legitimacy of what happened next. I see this whole sequence as a textbook market structure event, designed explicitly to exploit the mechanics of the system. That 1-for-50 split was the pivot point. It slashed the public float from over 130 million shares down to a microscopic size, about 2.6 million shares. That sudden, manufactured scarcity created the perfect low-float tinderbox. And then you look at the timing. This massive MOU, which we agree is non-binding and notably lacks any named counterparties, lands just 4 days later. It was perfectly timed to be the spark. It was designed, I think, specifically to induce retail traders who, chase big headline numbers, not 1% gross margins, to flood the market. So in my view, that 40% price jump is merely the temporary output of financial engineering used to inflate the valuation, which is the only way they can raise the capital they desperately need through future dilution. There's no fundamental improvement there.
Let's just focus on that catalyst for a second and its sheer scale. You mentioned the $980 million MOU. Okay, that is nearly 8 times the company's trailing 12-month revenue, which was a meager $124 million.
When you have a non-binding headline that big, landing days after you've manufactured this tight micro-float situation, it just screams coordination. This massive, unsubstantiated number creates an immediate, irresistible narrative of validated global expansion.
Okay, but
I get that in certain Chinese supply chain contexts, MOUs can represent strong intent. But for an ADR facing delisting with chronic negative net income, The convenience of this announcement suggests it was tailored to trigger momentum, not reflect a real, stable business deal. The timing and the size are designed to maximize speculative reaction and just paper over the dire financial reality.
I see why you characterize it that way, as, narrative manipulation. But let me offer a different perspective on the significance of that number and the timing. You're right, $980 million is a massive figure relative to their revenue. But we do have to look beyond just Western legal standards for these agreements. In the context of large-scale Chinese supply chain deals, especially for a company trying to expand its whole sauce plus supply chain model, these big, non-binding MOUs are often the first essential step. They establish a pipeline, they prove a forward market, they represent intent and the capability to scale.
But intent isn't cash flow.
No, but it's a prerequisite. And we have to pair this with their earlier announcements, like the partnership with Wanshan International Trading, which also targeted $1 billion in sales. So taken together, these aren't just singular, cynical announcements. They represent management consistently trying to secure a credible, necessary revenue pipeline to get them out of this crisis. They're building the infrastructure of confidence required to move from being an illiquid parts distributor to a real platform company. Without that confidence, no institutional money will ever touch them, and the NASDAQ listing is pointless anyway. The market, however speculatively, is pricing in the potential execution of that intent. And to address your core thesis about financial engineering, let's look at the market plumbing that was operating before the split. You suggest the spike was entirely manufactured demand, but I'd argue the market was already reflecting extreme structural volatility, which is just being amplified now. Leading up to that split, the off-exchange short volume ratios were incredibly high, consistently over 50% in early December, even peaking at over 61%. This high dark pool volume is actually typical when market makers are trying to facilitate liquidity during massive uncertainty. They're absorbing pressure to maintain order. This high internalization rate is designed to dampen price movement, not create it. The fact that the stock still moves so violently after the split just shows how much retail and speculative capital was flooding in.
I'm just not convinced by that line of reasoning, because the plumbing reveals structural distress that goes way beyond benign liquidity facilitation. It points to actors trying to short a stock that literally didn't have enough available shares to borrow. We need to look at the fails to deliver, the FTDs. Now, for listeners who aren't in the weeds on this, an FTD is when a seller fails to deliver the promised shares on time, often because they can't locate them to borrow for a short sale.
Right.
There was a massive spike in FTDs on November 12th, the very day the board approved the 1-for-50 consolidation. We're talking nearly 5 million shares failed to deliver that day. That is not normal for a microcap ADR. It means aggressive, anticipatory shorting exceeded the available float. It created a hard-to-borrow situation, forcing the stock onto the regulation SHO threshold list. And the mandatory buy-in demand from those failures is what fundamentally fueled the demand in December. This wasn't neutral facilitation. It was structural stress creating forced, mandatory buying pressure that management then perfectly exploited with their MOU announcement. And that forced buying pressure was immediately capitalized on by what you called retail speculation. The volatility is amplified by noise traders, retail investors who follow sentiment, not fundamentals. The data here is crystal clear. Sentiment on stock twits shifted instantly from bearish to extremely bullish right after that $980 million news hit. And even more damning, communities like our penny stocks were explicitly tracking the new microfloat of about 2.6 million shares. They understood the mechanics of the scarcity. They were anticipating a squeezy move because they knew the supply was tight.
Okay.
This confirms the movement is purely mercenary. It is entirely about exploiting the low supply created by the corporate action. It's completely divorced from any genuine belief in the company's so-called transformation. The movement is the trade.
That's an interesting point, and I agree the action was mercenary. But I'd frame the relationship differently. The realization of the scarcity created by the 1-for-50 split is a genuine structural change to the supply side of the equation. You can't separate the intent of those traders from the consequence of the corporate action. The split fundamentally changed the market's dynamics, and investors reacted rationally to that new scarcity. You know, if a car maker suddenly scraps 95% of its inventory, the remaining 5% will become highly volatile, regardless of whether the company is solvent. This volatility multiplier is an inevitable, if risky, side effect of a company fighting for survival. When the entire float can turn over multiple times in one day, as we saw, then relatively small amounts of capital can legitimately trigger massive price movement. Management knew this was the lever they had, and they pulled it.
Look, we have spent a lot of time dissecting the structure and the speculation, and I appreciate your deep dive into the FTD mechanics, I really do. But let's just return briefly to the possibility of a turnaround, because that is what ultimately justifies being on NASDAQ. While the financials are weak, we both agree on that, the reverse split in the MOU buy the company crucial time. The market is pricing in the potential for future growth in China's huge automotive digital transformation market. This narrative, while highly speculative, offers a chance for a genuine inflection point.
I'm sorry, but I just don't buy that potential. Let me tell you why. We have to look past the digital transformation narrative to the hardest financial reality on the page, the company's 1.0% gross margin. That single number is the most crucial piece of data we have. What does a 1% gross margin tell us? It confirms the business is a low-margin trading intermediary moving parts around, not a high-margin tech platform delivering SaaS solutions. Even if they miraculously hit that aspirational $1 billion in sales, a 1% margin yields only $10 million in gross profit. That sum is fundamentally insufficient to cover the operating expenses of a NASDAQ-listed entity.
Fair point.
The volatility, therefore, is a structural phenomenon where, as often happens here, the stock is the product and the business is merely the wrapper. And to make matters worse, let's not ignore the financing. Companies this desperate often use toxic financing. Convertible notes issued around these splits often contain what analysts call death spiral provisions, which guarantee continuous dilution by letting debt holders convert to shares at a discount. That guarantees constant future selling pressure that caps any true, sustained rally. The game is designed to monetize volatility, not generate long-term value.
I fully acknowledge the toxicity of a 1% gross margin and the extreme risk in those kinds of financing instruments. The economics are, without a doubt, a massive red flag. However, the sequence of events, the regulatory mandated split combined with the necessary establishment of future revenue intent, it demonstrates a management team aggressively using the few tools they had to survive an immediate delisting crisis. The price movement, while yes, undeniably amplified by market structure events like the FTD situation, is fundamentally rooted in corporate efforts to stay viable.
And conversely, I'll reiterate that the overwhelming evidence, the microscopically low gross margin, the massive anticipatory FTD spike creating forced demand, and the calculated timing of an unsubstantiated announcement, it all confirms that the December volatility was a calculated outcome of financial engineering. It was orchestrated to exploit a new microfloat environment for the sole purpose of raising capital through dilution, not to signal any real change in the outlook for this business.
Dissecting the dynamics of AZI, which for the listener operates as an American Depositary Receipt, or ADR, provides a crucial look at how market structure can temporarily dislocate price from fundamental reality. An ADR represents shares of a foreign company, and they often carry specific liquidity challenges. I think we have to continuously weigh the necessity of these compliance fixes against the underlying financial stability they're supposed to support.
Indeed. In this case, really highlights the unique complexity involved in analyzing ADR structures and low float volatility. When you combine a crisis-driven reverse split with potentially toxic financing, you create a scenario where liquidity itself becomes an illusion. It suggests there is still much more to explore regarding the true nature of price discovery in these highly volatile microcap issues.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.